Understanding capital gains tax. Capital gains tax is a type of tax levied on the profit earned from the sale or disposal of capital assets, such as stocks, bonds, real estate, or valuable items like art or collectibles. 1. Capital assets. Capital assets include property held for investment purposes or personal use, such as stocks, bonds, mutual funds, real estate, precious metals, and collectibles. Capital gains tax is triggered when these assets are sold or otherwise disposed of at a profit. Though taxable gain. The taxable gain from the sale of a capital asset is calculated by subtracting the asset's basis, usually its purchase price plus any acquisition costs, from the selling price. If the selling price is higher than the basis, the taxpayer realizes a capital gain. If the selling price is lower, the taxpayer realizes a capital loss. 10 types of capital gains. Capital gains can be categorized into two main types: short-term gains and long-term gains. Short-term gains are realized from the sale of assets held for 1 year or less, while long-term gains are realized from assets held for more than 1 year. The tax rates applied to short-term and long-term capital gains may differ. 4 tax rates. Capital gains tax rates can vary depending on factors such as the type of asset, the holding period, and the taxpayer's income level. In many countries, like the US, long-term capital gains are taxed at lower rates, contrasting with short-term gains taxed at ordinary income rates. 5. Capital losses. Capital losses can be used to offset capital gains, reducing the taxpayer's overall tax liability. If capital losses exceed capital gains in a given tax year, taxpayers may be able to deduct the excess losses from their other income, subject to certain limitations and restrictions. 6. Exemptions and deferrals. Some capital gains may be eligible for exemptions or deferrals under certain circumstances. Gains from selling a primary residence may be tax-exempt if conditions are met, and capital gains taxes can be deferred through like-kind exchanges or investments in qualified opportunity zones. 7. Reporting and compliance. Taxpayers are generally required to report capital gains and losses on their income tax returns and may need to include additional documentation or forms, such as Schedule D, in the United States. Accuracy in reporting capital gains and compliance with tax laws and regulations are essential to avoid penalties and audits from tax authorities.